Welcome back friends, welcome to the channel JAIIB and CIB Made Simple, and this is our 10-minute miracle series day number 7, and today we are going to discuss our unit number 36 derivative topic. We will revise all the important contents of this topic in just 10 minutes. So I request you to give your valuable 10 minutes time to watch this video, understand each and every word which I am speaking, and you will be able to grasp all the important concept related to unit number 36. You will be able to remember and memorize it for the long term, and if any question asked related to this topic, you will feel confident to solve that particular question. So now let's begin. First thing is, let's quickly break down what derivatives are and their history, so without the jargon. So what are derivatives? See, derivatives are like financial tools that get their value from something that is called underlying asset, like a stock like a commodity or interest rate, right? So these are some underlying asset: a stock, commodity and interest rate. Now people use them to protect against risk, hedging risk, or make a profit by betting on future prices. If you talk about the types, you have got ones traded directly between the people, that is called OTC, and on exchange, like forward, futures, options and swap, which are traded on exchange. So one side it is traded on for OTC, and other side it is traded on exchange. Now way back in the history, people traded goods without money. So if you talk about the history, you can see SCRA 1956 defined in section it is defined in section 2 subsection 2AC, and RBI value tied to underlying minimum investment. So if you talk about the history of it, way back in history, people traded goods without money, which was a kind of like the earliest form of contract. Now in 1600 BC, as you can see, a guy named Thales used something called a call option. So Thales used something called call option with olive oil. Fast forward to Japan, in 1700 they created the first modern future machine for rice, future market for rice. Now in India, the first derivative market started in 1875 with Bombay cotton trade. Remember it, this may be asked. By 2000, SEBI allowed future and option for big indexes. SEBI approved derivative based on LC Gupta committee. Remember this committee name? And it was based on the big indices like Nifty and Sensex, and even for individual stock. Some key milestone in India include, you can see BSE Sensex option, the launch of Sensex option in 2001 with BSE Sensex in June 4, 2001, and individual security option in July 2001, and Nifty launches in June 2000. Right, so that's a quick overview of the derivative. Hope that's clear it up to you. Now let's talk about the underlying asset. In the previous slide we have seen the derivative is value derived from underlying asset. So what are underlying asset? They are basically the things that have given derivative their values. Some example includes commodities like grain, coffee, precious metals like gold and silver, natural resources, currencies like foreign exchange, natural resources, bonds from government and corporate debts or company, and then after comes stock indices that track the overall market. Everything like oil and gas fall under this. Now when it comes to trading derivative, there are two main types of market, right? The first market is called exchange traded market. So these are like public market. These you can think exchange traded market like a public market. So everything here is standardized. You can see written, everything here is standardized and highly regulated with lots of transparency. They are safer, and you have even market maker to ensure there is always someone to trade with. So they are highly transparent and regulated. Now let's talk about the OTC. OTC means over the counter market. They are basically private deal. They are what kind of private deal? They are much more flexible and riskier, since they are less regulated. So this OTC is less regulated. After the 2008 financial crisis, you know about this 2008 financial crisis. So after the 2008 financial crisis, the OTC market faced more scrutiny. So that is the quick snapshot, and let's talk about the function of derivative. So let's dive into some key functions of derivative and break down forward contract and future. First, derivative do few important things. The first thing they do is price discovery. They help figure out the right price for the asset. The next thing is risk transfer. They transfer risk from one party to the another. Next comes risk management. They help protect against unexpected price rise, which we call hedging. So when I say hedging, it means unexpected price rise. Then after it come low cost, they make trading cheaper. Then after come market access, it means they open doors to market that are hard to get into. They are highly leveraged, meaning you can trade with less money compared to other investment. Now let's talk about the forward contract. See, a forward contract is an agreement to trade something like foreign exchange at the future date. Importer often use this to lock in exchange rate. If you calculate a forward contract, you have to first of all tell the spot rate, and then after you have to interest rate over time. The purpose of this forward contract is that importer want to lock in the rate. Now, customization, term negotiated OTC. These contracts are customized and negotiated privately, like OTC. This is over the counter product. Forward contract with no initial payment, and they must be fulfilled. Payment must be fulfilled when the contract ends, must settle at the maturity. Next comes future and obligation. Parties must fulfill the term. India genuine underlying required, and cancellation and rebooking are allowed with genuine underlying. Now if we talk about the future are like forward contract but standardized and traded on exchange, right? So they can involve anything from financial instrument to commodities. Financial instrument to commodities, all are included. With currency future, you agree to exchange a currency at a fixed price in the future, and just like forward, futures are legally binding. So that is called currency future. So that's the basics of derivative, forward and future. And now let's just move. So friends, if you want PDF of such type of lecture, you can enroll in our capsule program. In capsule program, we offer you such concise PDF which help you greatly in revising the content in short span of time, and you can revise the content multiple number of times. Also we provide MCQs. So for more detail regarding the capsule program, you can WhatsApp me on this particular number. Now let's talk about the forward versus future contract. Obviously you know that this future contract are standardized, and also they have a fixed maturity, right? So let's compare future and forward contract, and let then dive into interest rate future and option. See, futures are traded on exchange, and futures require an upfront margin, and their value is updated daily. That is called mark to market. And forward contract are private deal, as we all know, and their OTC means over the counter with no margin required, and you can trade them 24/7. In forward, you know the other party it, but that means you know the counterparty, but in future you don't know the counterparty. For example, let me give you an example. A company locks in $1 million. A company locks in $1 million at 75.50 INR per USD in forward contract. So they won't gain if the dollar appreciate, right? Now next up comes interest rate future, or we call it FRA. FRA, forward rate agreement. These contracts are about exchanging future interest payment. So main thing is here future interest payment. So we will exchange future interest payment here, right? Now if you expect the rate to what rate? Interest rate. If you expect the rate to rise, you buy an FRA to hedge. So if you expect that the interest rate will rise in the future, so what you do, you buy an FRA, you buy an forward rate agreement to hedge, right? And if you expect rate to fall, if you expect that interest rate will fall, you sell FRA, right? This is the basic concept. Now the cool thing is you are only dealing with the notional amount, no principal commitment, only notional amount is involved, right? No need to commit the principal. Lastly, let's talk about the options and some more details. Like example, you can see 3/6 FRA. This is how it is written, forward rate agreement, and in which case we have to buy, in which case you have to sell. You have to see this. Okay, now let's talk about the option. So option give you the right but not the obligation to buy or sell something at a fixed price before it expires. So it gives you a right, it not give you obligation to buy or sell something at a fixed price before expiry. So the asset like stock, commodities, bonds, right, that the option is based on, it's called the underlying. Now there are two types of option, call option and the second is called put option. Let's discuss these two types of option in the next slide. So option premium is the price you pay for the option, and there is something called a strike price, right? Okay, so call option gives you the right to buy. So this right to buy is given by the call option, and put option give you the right to sell. So sale is given by the put option, right? Now if we talk about some key terms, like option premium means the price you pay for the option. Strike price, the fixed buy sell price is called strike price. Expiry date, that means when the option expire. The option holder is the buyer and the option writer is the seller who must deliver if the option is exercised. Who is option holder? Who is option writer? Option holder is the buyer, right, who buy the option, and option writer is one who is the seller who must deliver if the option is exercised. Now let's comes to the next slide and let's discuss American versus European option. See, first let's talk about option. American option means you can exercise this anytime before they expire. You can exercise this option anytime before they expire. And European option means you can only exercise them at expiry. Let me give you an example. So if you have an European call option on Infosys, so your profit is the market price minus the strike price and the premium, right? Since it is European option, so it means you can only exercise them expiry. So what will be the market price? You can see, for example, Infosys, you have European call option, your profit will be market price minus strike price minus premium. Now let's move on to the swaps. See, swap is when two party exchange financial instrument or cash flow. So two party exchanges financial instrument, two party exchanges cash flow, then swap happen. There are of different type. The first is called currency swap. You exchange principal and interest in different currency. That is called currency swap. Exchanging principal and interest in different currency is called currency swap. And it is very great for cheap borrowing. It is very great for cheap borrowing in your home currency. If you are borrowing cheap in home currency, this is very great. Currency swap is very great, and swapping it for foreign currency, right? And now let's talk about interest rate swap. You exchange interest rate payment, that is called interest rate swap. Then comes credit default swap. You transfer the risk of credit default. So there is a risk of credit default and you transfer that particular risk, and this is called credit default swap. So I am giving you an example of the credit default swap. So an Indian and American subsidiary could swap their loan interest payment and principal in their respective currency. So this is an example of credit default swap. So we have discussed currency swap, where principal and interest in different currencies exchange. Interest rate swap, where interest rate cash flow is exchange. Credit default swap, when credit risk is exchange. Now you can see currency swap benefit. And now let's discuss IRS. IRS means interest rate swap in detail. Already I have told you, in the case of interest rate swap, you exchange interest rate payment. So in the interest rate swap, what you do, you exchange interest rate payment on a notional amount. There are two types. First is fixed to floating. So fixed to floating means you exchange a fixed interest rate for a floating one. So you are exchanging a fixed interest rate and you are taking floating interest rate in return. And the second is called floating interest rate. So floating to fixed means what? You are exchanging, you swap a floating interest rate for a fixed one. So people use this to reduce cost or hedge against interest rate movement. So that let me give you an example. Like you can see, a company might swap a fixed deposit for a floating loan. You can see this is FCNR deposit which is fixed, and it is trying to swap a fixed deposit for a floating rate loan. So this is a type of floating to fixed. When I told you that exchanging floating for fixed, right? Now if we talk about fixed to floating, like fixed rate bond versus floating corporate financing, so our company might swap fixed rate bond for floating rate corporate financing. So this is example of fixed to floating. Let's talk about the CDS. So CDS means credit default swap. And what is CDS? It is basically a contract that help an investor protect against the risk of someone not paying back their loan or bond, also known as default. So CDS is a contract that help an investor protect against risk of someone not paying back their loan. So suppose someone is not paying back their loan, obviously there is a risk, and this risk, to protect against the risk, the contract that help an investor is called CDS, credit default swap, right? So how it works, let me discuss. So the buyer of a CDS buy premium. So buyer purchases CDS, buyer of the premium pay premium like insurance fee, right? Premium payment is paid like insurance fee. The seller of the CDS promises to reimburse the buyer if the borrower default. So if the borrower default, the seller will reimburse. So the risk of default is transferred to the CDS seller, but if it is not, eliminated completely. If the borrower is riskier, the CDS premium are on higher, right? So now let's talk about the RBI guideline. In 2021, RBI releases draft guideline to allow retail user to hedge against credit risk in India. So as you can see, this was RBI guideline which was for regarding the CDS. As you can see, in the case of CDS, there are three parties: borrower, CDS buyer, and CDS seller, right? And RBI drafted guideline in February 2021, which is related to which allow retail user to hedge against credit risk in India. Now, retail user can use CDS to protect against credit risk, while non-retail user like insurance company, pension fund, mutual fund, big company can also use CDS for other purposes, right? And now this CDS contract will be standardized and traded on exchange with cash settlement to keep things transparent, right? So to keep things transparent, all these things have to be done. Now let's talk about the ISDA agreement. So let's quickly go over the ISDA agreement, what it is all about. So you can see that ISDA agreement, derivative security, and how CDS contract fit into all this. The ISDA agreement is a standardized document for OTC derivative. Remember, it is a standardized document for OTC derivative documentation, and it was developed in 1985 by the International Swap and Derivative Association. Remember the full form, International Swap and Derivative Association. This is the full form of ISDA. It simplifies the standardized term for derivative trades. Now, what are the agreements which are included? The first is called master agreement, which means the main legal document. Then second comes a schedule. So a schedule is a custom terms. Then next come customization or confirmation for a specific trade, and last come different booklets and credit support. While setting up it takes some effort, it makes future transaction much easier because everything is already agreed on. Now let's talk about something called derivative security. Obviously initial effort is required, but easiest future deals. Now derivative security are what? So derivative security are financial instrument whose value comes from something else, like a stock or commodities, and they don't have intrinsic value on their own. They can be traded on exchange or OTC. Common example include forward, future swap, and forward, future options, and swap. Now lastly, CDS and ISDA documentation. CDS is like insurance against someone who defaulting on their debt. So someone is defaulting on their debt, and insurance against someone is called CDS. And ISDA master agreement, a standardized CDS contract helping reduce dispute and clarifying risk. So this CDS agreement, it includes general terms but leaves the specific detail for later. So that's a quick breakdown of the ISDA agreement. If you really find this lecture useful, please hit the like button. And if you want PDF of this, you can enroll in our Ie&Ifs capsule course. For any suggestion or for any guidance related to JAIIB, feel free to WhatsApp me on this particular number. Link is provided in the description section. Thank you.